So let's get right into it. We just watched three huge fintech companies get hit by the exact same storm, a political one brewing in Washington, D.C. But, and this is the fascinating part, how they reacted could not have been more different. We're going to break down how Coinbase, Circle, and Robinhood each tried to navigate this complete chaos. You know that feeling, right? That is the perfect way to describe what the market felt like. One minute, everything's cool. The next, it's absolute madness. This quote just perfectly captures that sudden, chaotic energy that completely took over the crypto stock world. And really, what this whole thing turned into was an unexpected, real-time stress test for the entire fintech sector. Just one single fear about a new policy was all it took to send these huge shockwaves through the market. And in doing so, it revealed the unique DNA of each of these companies. So what was the trigger? Well, it all comes down to a piece of legislation called the Clarity Act. It's working its way through the DC machine, and it carries this major threat, potentially banning the yield, the interest-like rewards you can get on stablecoins. You mix that with a general risk-off mood thanks to global tensions, and bam, you've got yourself a perfect storm. All right, so first up, Coinbase. They found themselves stuck right in the middle of this whole mess. You've got this short-term fear pulling them one way, and this massive long-term opportunity pulling them in the exact opposite direction. And wow, the market did not wait around to react. Coinbase stock took a pretty big hit, dropping about 8% as investors started pricing in this new regulatory risk. It was a really clear signal that Wall Street was getting anxious. Now, you might be asking, why is this such a big deal for Coinbase? Well, stablecoin yield isn't just some small feature for them. It's a core part of their whole engine. See, they get a piece of the reserve income from USDC, and offering yield products is a huge, huge incentive to get people onto their platform. If you take that away, the whole flywheel could really slow down. So for Coinbase, you've got these two totally competing stories playing out. In the short term, regulation is scary. It threatens a major revenue stream. But the long-term view? It's that clear regulations could be the very thing that unlocks massive institutional money. The source actually called it very euphorious season finale energy. Total chaos right now, but with the promise of some kind of clarity later. And check this out. To really drive home that long-term optimism, while the market was freaking out, analysts at Citi called Coinbase a beta play on clarity. They're basically saying that if or when the regulatory fog finally lifts, Coinbase is set to be a massive winner. They even slapped a huge $400 price target on the stock. So the big takeaway here for Coinbase? It's pretty simple. Its stock price has become less about the daily price of Bitcoin and way more about the whispers and debates happening in the halls of Congress. Its future is now tied directly to policy. Okay, so that's Coinbase. Now let's shift gears and talk about Circle. Because if Coinbase was caught in the crossfire, Circle, the company that actually makes USDC, took the hit head on. As what we call a pure play specialist, they were the most exposed, period. And man, did the numbers show it. We're talking a staggering drop of around 20%. This wasn't just a dip, this was a wipeout. The market's reaction was so much harsher because Circle's entire business model was sitting in the regulatory crosshairs. So why the huge drop? It really comes down to one thing: diversification. Or, well, a lack of it. See, unlike Coinbase, which has trading fees, subscriptions, all this other stuff, Circle is a pure play. It basically is the USDC company. So if stablecoin demand tanks because yields get banned, Circle feels that pain directly and instantly. But right when everyone's hitting the panic button, you've got this wild counter move. Cathie Wood's ARK Invest does what it's famous for. It bought the dip. They swooped in and grabbed about $16 million worth of Circle's stock. It's a classic, high-conviction bet that all the fear was just overblown. And look, Circle isn't just sitting around and hoping for a rescue. Nope. They're making a huge strategic pivot. Their game plan is basically, if the US market gets hostile, fine, we'll go global. They've already announced a major partnership to expand USDC into 30 countries in Africa, targeting that massive market for cross-border payments. So when you boil it all down for Circle, an investment in them is a pure, concentrated bet on the future of stablecoins. And while the payoff on that could be enormous, it also means that right now it is an incredibly volatile place to be. All right, that brings us to our third story, and honestly, it's a completely different vibe. While Coinbase and Circle were busy reacting to the storm, Robinhood was playing another game entirely. They weren't just defending themselves, they were actively building a financial fortress. So what was their first move? Announcing a massive $1.5 billion share buyback. This is pretty much the ultimate power move a company can make. It's management telling the market, hey, we think our stock is cheap and we've got the cash right here to prove it. And they didn't stop there. They also beefed up their revolving credit line to $3.25 billion. You can think of this like a giant, super flexible corporate credit card. This isn't about being in debt. It's about having a war chest ready to go so you can weather any storm or jump on any opportunity that comes along. This quote from the source material, it just nails it. It perfectly sums up Robinhood's transformation. The company is shedding that old skin from the meme stock days. It's becoming less about risky YOLO trades and way more about solid, strategic CFO core financial management. So the bottom line for Robinhood is that we're watching it grow up in real time. It's moving way beyond just being a trading app. It's becoming a mature company that thinks like a chess player, using its capital strategically to build a stronger foundation and create long-term value. Okay, so let's pull all these threads together. We've seen 3 totally distinct reactions to the exact same market shock. Now let's see what these different paths could mean for their futures. So to recap it all, you've got Coinbase stuck in the middle. Its fate now hanging on what Congress does. Then you have Circle, the pure play specialist that took the biggest punch and is now looking abroad. And finally, you have Robinhood, which used the chaos to flex its financial muscle. 3 very different companies, 3 very different strategies. And that leaves us with one last big question to think about. When these market storms hit, and they always do, who's really better positioned to win in the long run? Is it the focused, pure-play specialist like Circle, who lives and dies by one single thing? Or is it the diversified, fortified giant like Robinhood, who can afford to play the long game? Something to chew on.